Hello guys, welcome back to our channel. Today's our video topic is loan types and the bank leading channel. Practitioners commonly refer to four distinct loan types: asset-based loans, cash flow loans, trade financing and leasing. It is important to account for these different in type loan type in order and analyze the economic significance of credit market disruptions. Using credit registry data for USA, we document that four main types of commercial credit: asset-based loans, cash flow loans, trade finance, and leasing are easily identical and represent the bulk of corporate credit. We show that credit growth dynamics and bank leading channels vary across these loan types. Moreover, credit supply shocks previously identified in the literature appear to be driven by individual loan types, the effect of monetary policy, and the effects of the financial crisis propagating throughout banks. Balance sheets are primarily driven by cash flow loans, whereas asset-based credit appears to be largely insensitive to these type of effects. Paper information: full working paper text, working paper publication dates April 2020, HBS working paper phone number, working paper serial numbers 270568. Finance. So guys, the best working loan types and insurance policies, the crisis of loan program, previous jobs and made money. Following the 2008 financial crisis, USA offered a business loan program that helped firms, employees, and even the government. As the US Congress prepared to replenish its Paycheck Protection Program for small business, questions still linger: do granted loans for small business work in the long term? Who wins? Employees, business, taxpayers? The answer appears to be yes for all three, with impact leading years after an event phases. According to recent research based on a survey examining French firms with fewer than 250 employees during the global financial crisis last decade, conducted over a 7-year period starting in 2008, the research shows works and firms who received guaranteed loans enjoyed a more stable career path. The firms themselves also grew stronger, and the French government eventually saved more in unemployment benefits than the program cost. According to the study, the research was conducted by Boris Vilas, the Torsten Hagen Associate Professor of Business Administration at Harvard Business School, and three colleagues: Thorsten Martin and Julian Italy, Bicos University, Paris School of Management. How to keep small business loan and effect make sure they eventually thrive. Firms that received loan guarantees and their employees enjoyed far more stability than their countries. So guys, a coaster in USA. A dozen years ago, the Great Recession unfolded. French small business also faced prospects, or what economists call a shock. To measure the effect of policy on firms, employ the research between regions and the varying loan guarantee program. By 2015, the research found workers from beneficiary firms were still earning more. Their counterparts, employees, were also significantly less likely to have charged employees, the researcher writes. What was surprising to us was the procedural effect the even 7 years later. So guys, there is a very small limited countries who give us a loan and insurance policies. So that's we talking about Debt financing hurdles for insurance companies. Banker McKinsey Lyer explained the challenges faced by regular insurance companies when seeking leverage debt financing. But what if the nature of a particular market? A brief history of debt financing in regulated insurance market. Insurance traditionally fund their operations through the receipt of customer premium payments and complex money management strategies that take into account risks, return models, and regulated capital adequacy requirements. Still, like any company in the industry, insurance companies need to consider all sources of funding when building the optimal capital structure, including third-party leading in its traditional firms. Financial sponsors who typically operated a leverage investment approach are incredibly looking to regular booking beverages, capital structure use of finance and equations. Unlikely it ran leverage financial models, EBITDA or constant cash flow regulated insurance business may not be represented measure of true liquidity. Regulated insurance market, what's a different? Overview. The global insurance industry is highly regulated with many internationally and locally focused organizations provided oversight. Internationally groups, the International Association of Insurance Surveyors, stability of the international financial market which is balanced against the need to ensure the policyholders are treated impartially. These regulatory initiatives are similar to Dodd-Frank in the US, where insurance industry regulation is primarily state-driven, with federal oversight established. In the way of the market destabilization caused by the financial crisis from the prior decade. The key objection of these regulations including promoting global competitiveness, reducing insufficiency company and insurance markets, alien industry and insurance ability. The consideration lead a unique set of issued and regulated insurance space debt financing including in the complex of regulated insurance asset generally follows traditional form, but in the case of a regulated insurance with an additional set of hurdles are similar in many ways to issues facing our FIG financial institution group financing. These include regulated versus unregulated business, managing and access to the relevant insurance similar to other industry financial sponsor insurance complexity in the context of competitive bid process of regulated insurance asset. While they analyzes the regulator and interfacing with financial sponsor more frequently, access to the relevant regular may not always be able to bid the some insurers approve the financial sponsor proposed acquisition structure including in required provide certain bids in the trade buyers. According financially sponsor may run multiple commitment papers or structure with their lenders. Ability to upstream cash. The ability to upstream cash from regulated operating companies in order to make interest payment or external debt. Distribution reserve. If debts holding company in a service via interest payment or shareholder loans, such loans may need to include restrictions or early payment and period in order to qualify or capital under the application servant. So insurance requirements among other factors may limit the pool of insurance guarantees that may be available in insurance. In addition, the term of the debt may need to provide for the automatic release of security guarantees guaranteed by non-regulated entities in the group if such entities fall within the scope of regulation. Financial insurance. These structures are more evident insurance deal in light of the security. guarantee and debt service. Restriction discussed above the as financial sponsor look at their leverage structures above the regulated group, local law consideration, local console. So insurance is a very unique thing. You must be add in insurance. You must invest in insurance. So guys, I hope you are agree with me. Please like, share and subscribe to our channel. Thank you.